Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from New York City. Welcome to the show, David Becker.
Thank you. Thank you for having me. Happy New Year.
Well, great to have you here. Dave, you and I have known each other for a while. You're part of Time Equities, one of the principals there. And last time you were on the show, we talked about strategy. I'd love to get an update. There's been a lot of uncertainty injected into the market and, see how your investment thesis is changing, if at all. But maybe before we do, for the folks who haven't met you yet, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure. Yeah, so I'm the head equity strategist, and I sit on the executive committee at Time Equities. Time Equities is a $8 billion private real estate investment development company. We have properties all over the United States. I think we're in 36 states now, a large presence across Canada, and I think 6 countries in Western Europe. And then we have a resort property, marina property in Anguilla in the Caribbean. So we're a highly diversified company. And we've been around a long time, dates back to the mid-'60s. And I've been here about 25 years, so somewhat of a lifer, spent a majority of my career here. And we manage a number of investors, and we have a number of joint venture partners throughout North America and Europe. And I'm happy to share our investment thoughts.
Love it. Well, David, especially over the last little bit, even just coming out of the White House this week, there's a flurry of announcements, and there's another flurry expected between now and the World Economic Forum meetings. All of that injects change, some of it positive, some of it not, but investors hate uncertainty. They love boring. Just tell me the rules and I'll work within the rules is kind of the thought process. How is this affecting the way you're looking at the market?
Well, we're sort of believers that I guess having a highly diversified portfolio is good. And then in some, I don't want to say bad, but some is can be a little bit more bland when a certain sector is taking off or a certain sector is seeing particular excitement. So we have the benefit of seeing things from a variety of different asset classes. We're invested in industrial, residential, we build residential, student housing, office, land transactions. So we really see it from across all real estate gamuts. And also geographically, because we're highly diversified, we see a lot of different locations. There are certain things happening in certain parts of the country that are different than other parts of the country. And so you have to contend with that and pricing, of course, and then asset class dynamics. It's funny, if you miss the news one day, be totally behind it. It's just like, used to be watch the news, once or twice a week, a couple times a week, see what is happening. Today, it's almost hourly or every couple hours. Obviously, big events happening around the world as we speak. And then, of course, real estate is so dependent on the interest rate environment. Of course, how these things interface with the interest rate environment, all those things critical. For the most part, I would call us a defensive opportunist. And by that, I mean that we typically are defensive in nature, but also look for longer term upside. So it's more or less status quo for us in terms of our real estate investment thesis at the company level. We're buying a lot of things all cash, and we're doing that so that we can gauge the debt markets and also do some value add along the way and position certain properties for ideal financing. We do think that there's going to be some interest rate favorability in the coming year. And, those are obvious things just based on what everyone is seeing. And of course, most real estate assets are priced off of the environment of the debt markets. We're also ones to, frankly, try and take advantage of certain disconnections in the debt market. So if there's not financing available, I would argue that if you can buy a very good property at a better cap rate or a better price and then finance it when things stabilize, that might be a better strategy than buying things at a heated price with better financing, which is a moment in time. Then you have to sort of face the music at some point when the debt rolls. But I think generally we're looking at things cautiously, but we're always active and every market unto itself.
Now, are there certain asset classes Obviously, office is one of those that has gone through a tremendous amount of transformation that is a no-fly zone for you at this point.
Well, I would have said that a few months ago, but we just closed on a large opportunistic office transaction in downtown Denver. We just acquired a million, don't call us crazy, but we just acquired 1 million square foot, half leased class A minus office property in downtown Denver with a 1,000 car parking garage. And we bought that from a large bank that was taking a significant write down. And I think they just had deal fatigue on it, and it had at one point, been stabilized and had valued out at much higher number. But when I tell people about the metrics, I want to say we paid around $50 to $55 a square foot, which by metrics of basis is very cheap, and it has maybe a double-digit return on just the occupied portion. So it seems very opportunistic, but I always tell people when we're looking at office, someone's got to actually lease the space. It costs money to do that. You got to find tenants. And in this particular case, we had some longevity with one large tenant that gave us some terms, so we felt comfortable. And I think, like most assets, there's opportunity when banks or municipalities are operating them, and they're just not focused on it, and it's not their expertise, not what they do. So hopefully we can bring some, operational execution to it and get it leased up. And I think if we can, we'll look back, it'll be a good buy. But I would say that other than a very, very opportunistic office transaction, we're avoiding that asset class for the most part. Although there is some leasing happening. I'll make a note between Europe and the US. In Europe, they're not seeing the kind of office weakness. And so our office portfolio in certain markets in Europe are doing very, very well. So, I'm not exactly sure what's driving that, but the culture is to go to the office, and that's what people have been doing. So there's been leases getting done. In the US, it's very different. Everyone is shied away from office. It's been a no-go zone for 2 years, 3 years now. So you're still seeing some continued erosion there. Of course, residential and industrial are the two favorite children. And that's been consistent now for a number of years. The demand for residential is still very, very strong. And we can get into a little bit more on residential in terms of what's happening at the large institutional level. But industrial, very high demand in what we're seeing. So we've been focused on some below market leased industrial, some outdoor storage, and residential. We have a large project that we're about to go into the ground on in the spring, summer in Boynton Beach, Florida, which will be a large 450 unit residential property. That'll be an exciting one to work on, Class A.
I love it. Now, when we talk about residential, there's certainly lots of markets right now that, with the flurry of completions that have taken place over the last couple of years are saturated. Are you also taking an opportunistic approach on residential, or are you looking at those pockets, those Swiss cheese pockets of undersupply?
Well, we become opportunistic on residential typically when we've done two things. One is we've bought land and gone through the entitlement process, got it zoned, got it ready to go, and created value. And I think that exists. That's the story with Boynton Beach. We just completed that large tower in downtown Chicago, 1000 M, South Michigan Avenue. So I think when you're creating the value, which is land value, entitlements, construction, everything, development, lease up, there's inherent value if you've done it right. Where we've become a little bit more optimistic is where we went in as a mezz or a B note lender on a residential project. And for whatever reason, the developer either getting caught with that over leverage, or as rates were accelerating the last 5 years, got into trouble. And unfortunately, we've had to take some of those projects over. And so it's become opportunistic, but it wasn't the original intention. So those are the two sides of the equation. I do think there's more of those scenarios coming, but lowered rates might bail a number of those out and give the developer time to hang in there. The demand has certainly not weakened. The residential demand, meaning the actual demand for housing, whether it's for sale housing or rental housing, is very, very strong.
Yeah, I agree with that. What are your thoughts on hospitality?
We historically have stayed away from hospitality. Occasionally we'll have a hospitality asset mixed in with a mixed use in some way. And so from that perspective, we see it. But we, generally speaking, I'd say that's the one primary real estate asset, although we would make the argument it's not really a real estate asset. It's actually an operating business. And it's why it's not one of our core focuses, whereas we feel like we're more better suited to focus on real estate assets. That's a different breed. But occasionally we see certain things. There's a little bit more fluctuality in hotel market. I think you can be opportunistic in that world right now, for sure. And I think it's very property market and brand specific.
Yeah, no question. No question. When we segment residential, segment apartments, there's this one segment that we've become increasingly attracted to ourselves, which is the active adult segment of residential multifamily, because it seems to be a gap filler between the senior housing independent living product and a market rate apartment, where it's a discount to independent living, but a slight premium to market rate with a long tenant tenure, typically 9-10 years. So it's a much stickier offering. And on the flip side, of course, the absorption is going to be a bit slower, but it seems to be fitting a need, at least for the foreseeable future, with the demographic shifts as they are. What are your thoughts on that segment? Is it something you've played in at all?
I totally agree with your sentiment and view on it and the way you articulated that. I think that they typically, if you're a buyer or a renter, you're getting a better deal for your value than if it was free market. And that's because you have less of a market to go after as like the developer or owner of that asset. So rents typically are discounted relative to free market. And I agree with you on the shift with demographics. And I think you have a number of people that are downsizing, and particularly with just increased costs that we've all experienced in the last 7 to 10 years. I think that's become a very good solution. And so, yeah, we don't have one. We have apartment complexes that we've built or that we own that cater more toward them, but not technical 55 and older. But I share your sentiment that I just said someone in my office who's from Orange County, but who plays in the Mid-Atlantic region from a family office perspective on exactly that, which is 55 and older, Mid-Atlantic, senior living. And they're having a good experience because, of course, you get quality of life combined with economics.
Yeah, I love it. Well, David, if folks want to connect, if they want to learn more, what's the best way?
Well, I love to talk to people. I'm happy to speak to anyone, but you can reach me, David Becker at Time Equities. My email is dbecker@timeequities.com. That's usually the best way. You can send me a note, or you can find me on LinkedIn, or generally maybe some other Google or social media dynamics. But I think email is typically the best. And hopefully you see me out and about and being active and traveling around to see our properties and investors and partners and even you, Victor. I'd love to see you at some point soon. Hopefully we can have a drink or have lunch and catch up.
Well, I'm probably going to be in Manhattan actually in the next couple of weeks, so let's set that up for sure.
Let's do that. I'd love to have you.
Awesome. Well, David, great to connect. And for the listeners at home, definitely reach out to David Becker at timeequities.com. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.